Hello, everyone. As promised, I have done the presentation for risk management. So let's get into it. It should only take 10, 15 minutes. Again, I'll send this out to the groups. It'll be on Facebook, I'll put it on my YouTube channel, so you know that you can always come back to it in the future. But I tell you what, if you find any of these things confusing or you want more information, we can always do like a group Q&A session. So just let me know what you think. So without further ado, risk management, the whole principle behind it is keeping you in control of your account. Vitally important. What we're going to cover today is mindset, risk management rules, lot size and how to calculate, pips and stop losses, risk to reward, and then we're going to look at the signals that we're receiving, the pro and TCAP trade. So let's jump in. So mindset. You'll hear this a lot on a lot of the videos, and a lot of people talk about this. Trading is 10% skill and 90% your mindset. Huge, huge numbers. You've spent a long time learning how to trade, and still the majority of your success comes from your mindset. So a couple of rules. You must not trade with emotion. Really, really hard, this one, especially early on. But if you hit stop loss or take profit, really, you should react the same. You should be like ice cool. Something like Baz Kujan explained when I first joined. I was watching his training session, and when he hits take profit, you know, he just like, well, yeah, it should. If it hits stop loss, okay, it was either his analysis that was wrong, or he was in too early. But the trade's not over. It's another opportunity potentially after some further analysis. So being emotive, try to remove that from your trading. Wesley will back me up on this one. If you ever think about revenge trades, turn your phone off. Do something else. You know, don't go into a trade when you've lost, trying to make up those pips without any further analysis. If you're trying to revenge that trade, get away, because you know you could be in a sell and it's gone up, hit your stop loss, and you think, right, I'm gonna buy it now, it's going up, and then it does start to turn around, it hits your stop loss again. You know, you need to be, again, ice cool. Revenge trading isn't cool. Try and avoid that wherever possible. So when you get greedy, again, someone said this to me, I can't remember who, but the market has the habit of like smacking you in the face. So an example of this is, say you've got like a daily target, which we'll get to soon, and you've hit your daily target. You should be done. That's your daily target. Again, what can happen is you could think, well, I'm on a bit of a winning streak. I'm going to do one more trade, and that trade then blows out all your profit because you hit stop loss or whatever. You try and go, you know, into heavy, try and sort of rush along. Don't get greedy. Hit your target and then trade tomorrow. So we talk about personal development a lot. I don't know if any of you are doing it, apart from Tamra. I know you are, and Wesley, I think you've jumped into this now too. But if you're not doing personal development, then quite simply you should be. You know, the bit at the top says that trading is 10% skill, 90% mindset. So if you have your dedication to learn how to trade, you should be dedicating learning how to keep your mind, you know, in the right state to be able to trade effectively. Your skill, you'll only be able to utilize that skill if your mindset is right. Mindset is massive. You should be doing something already. Now there's some quick wins. There's audio books, there's literature on the AMI Finance website. Des has created a whole library of PDFs for books, audio books. You've got YouTube, you've got motivational videos that are sent in some of the groups. There's loads and loads and loads. If you want to tap into it, let me know. But you can do it whilst you're in the car. You can do it whilst you're having your breakfast. You're going out on a run. Like 30 minutes a day is all you need to do, and your mindset will be where it needs to be before you trade. There's some risk management rules that I follow. Don't get me wrong, I'm not preaching here, but the reason I wanted to do this is I want you to be in control of your account. Like I said, fortunately, I've learned the hard way. So these are the rules that I now follow because I wasn't doing it before. So learn from my mistakes. It's quite widely known that around 80 to 90% of amateur traders lose money. The reason why they lose money is they don't understand risk. You've just spent, again, hours and hours of your time learning how to trade so that you're not an amateur trader. So don't be an amateur when it comes to. I don't want you to blow your account. I'm sure you don't want to blow your account. I think anyone in IM or AMI Finance or the A team want you to blow your account. So this is something that we all really collectively should be supporting to do. My rule is I don't risk more than 5% of my account in any single day. The maximum risk that I'll look to trade over a daily period. I think Manny mentions this in his videos, but the reason why this is really, really a key figure is it would take you around 30 days to blow your account if you lose every single trade. Every single day you lose 5%, it would take you a month. Well, 30 days in working days is sort of 6 weeks. So it would take you an awful long time to get down to zero. And hopefully, before that would happen, if you're on that sort of losing streak, you would stop and you would jump back into your education, or you would approach me or one of the other leaders, and we could on track. So that's why it's important. Blowing your account should take a long time. If it's a process and you've over risked your account. So give you an idea of sort of splitting your risks. I like to do 3 to 5 trades a day. So you can split your risk over those trades, obviously. So if you're doing 3 trades, you can do 2% on one, 2% on the second, 1% risk on the third. All of them lose, which I hope they don't, but you still only lose 5%. So hopefully that makes sense. If you're doing 5% of the 3 trades, then you're risking 15% of your account. That's way too much. 5% a day, that should be absolutely all that you risk. Now, Manny talks about this again in his videos. Move your stop loss to entry when you're 20 pips or more in profit. Again, think about what we've just talked about, 221. If you're 20 pips in profit on a 2% risk trade, and you move your stop loss to a pip in profit, that 2% risk is now gone. You can now look for a new opportunity, a new trade, place 2%. So you've now got 4 trades in play, but you've still only got 5% risk. Okay, that's how you can then, start to add and really, really ramp up your profit with keeping the same amount of risk. Really important. But by doing all of this, the risk management philosophy is you're in control of what you're willing to lose, not what you're willing to win. The wins will come anyway, but being in control of what you're willing to lose is where your emotion parts ways with reality, and you're being very factual. You're being, black and white numbers. I've got an amount of money. I know that if it all goes wrong today, I'm £20 down, or whatever it might be, whatever your 5% is. Being in control of what you lose in a day is absolutely fundamental. You need to be aware of. The reason why this is important, I've put this slide in because extremely powerful. So take a screenshot if you want to. If you haven't done this already, then definitely do it. The website at the top there is where the chart comes from below. Now you need to understand the power of compounding your account. I'm reading a book at the moment called How to Own the World. He states in that book that compounding interest is the secret of the super wealthy. As soon as I heard that, I already knew the power of it, but wow, the super wealthy, that is me. That's where I want to be. How does it work? So look, this example is you starting off with a £200 account. What it does is you can play with the options on the calculator, and I can go through that with you individually. But you can literally put in how much you want to make a day. I've put 5% in this example. And over how many days do you include weekends, blah, blah, blah. We can go through that. But this is 5% a day from a £200 account. You can see there, day one, you're looking to make £10. That's it, £10. That is 5% of your account. When you get to day 10, you're making £15. Your account's now at £325. So if we jump down to day 40, so a couple of months in, you're trying to make 60 odd pound a month. Your account's at £1,400 for 102 months. Right, that's 40 years. If you put that money in a bank account for 40 years, you wouldn't be near that. 40 years. You can do that in 40 days. That's the power of what we have at our fingertips. If you go further down, so look at 125 days, you're looking at a £4,000 return in a day. That's 5%. That's also your risk that we talked about. If you achieve your 5%, you can make your account is going to be at 89 grand. Just after Christmas. But look at what the number equates to after a year. So July the 7th, 2021, exactly a year from now, your 5% risk and reward, if you want to look at it that way, is, what is that? 3 million. Yes, £3 million that you're trying to make in a day. Right, that number is just outrageous. If you were to do that, your account is going to be, just shy of 68 million. That's from £200 in 1 year, growing your account by 5% a day. Risk management is absolutely fundamental to get you anywhere near that figure. If you lose 5% a day, it doesn't matter. You can make it up on other days. So yesterday, I risked my account 5%, and I made around 17% profit yesterday. So there'll be days where your profit is way over 5, but your risk is never more than 5. So follow the plan, give yourself targets. If you can't control a small account, you're going to be out of your depth when the money gets bigger, because the figures are going to get bigger. You're emotionally trading. It all comes together with risk management. So lot size, I hope you all know this, but just to clarify, the lot size is purely the amount of money you're risking per pip. It's the first thing that you should work out before you enter any trade. And there's a couple of ways you can do that. So we've got a few tools. Again, take a screenshot of this when the slides are complete. But there's a desktop website called MyFXbook. I've sent it in the group before. I can send it again if you need it. Just give me a shout. There's an app on your phone called Stinu, which is what I use now. I don't use the desktop calculator anymore. I use Stinu. It's really quick and really easy. And these tools will tell you the lot size, so the 0.08 or the 0.14. The amount that you're risking per pip, per trade. That's what these tools give you. It's the only thing. So your lot size, when you enter a trade, it's the only thing that cannot be changed once you're in the trade. It has to be correct before you enter. Otherwise, you're over risking or under risking. It's going to be harder for you to achieve what you want to achieve. All right, let's talk about pips. So pips, again, once you're through your education, have a good understanding. When it comes to working out pips, that takes a little more practice, longer than others, but it is all practice. There's a couple of ways we can calculate pips. You've got the old-fashioned add or subtract. So I've got an example. If we look at GBP USD, the entry price is 124.767. My stop loss, remember we're looking at risk, is 1.24961. The pip is the third and fourth numbers after the decimal. The last one is the pipette. We all know that we ignore that. So it's the numbers in the boxes. That the difference between those numbers are what your pips are. Hopefully you can all see that is a 20 pip. That's one way we can look at calculating pips. On TradingView and the harmonic scanner, you have this toolbar. Hopefully this is all familiar to most of you, and you can use a long or short position, which is this icon here. So I've got an arrow to it. It looks a little bit like this, and this, again, the difference between the price, remember it's the third and fourth digit that we look at. So we're looking at a 20 pip stop loss, and this would be a 50. Also on TradingView and the harmonic scanner, you've also got a, which looks like a ruler, and that if you drag it across TradingView or the scanner, it tells you how many pips that area is. So if you're looking to a certain price, you can click where price is now and drag it to where the stop loss or profit level would be. In this example, a big move at 378 pips. So you can use all of these tools to help you work out the pips. You can use them in combination with each other. So I sometimes do that. So I'll look at option 1 normally, and then just confirm it using the long or short position. But again, practice makes perfect. Okay, risk to reward. Something I've sort of played with, and it's really, really powerful. So I aim now for a risk to reward of 1% risk, 3% reward. Example, got a 20 pips loss, a 60 pip take. So let's say you place 3 trades, all at that ratio of loss to profit. Ready for this? This is where it gets exciting. So you can lose 2 of those trades. So you would have lost 40 pips. And you can win 1, which is a 60 pip win. You have a 33% success rate of a trader, and you can still make money. That is insane. Imagine that you are 66% success rate. You've lost 20 pips, gained 120. You are now flying. You'll be adding to your account more than losing. Again, another part of managing your account effectively to make sure that you stay in control. I think this is my last slide. So signals. So hopefully you've seen the signals in the groups. You've been taking them on demo and live. So this is just a recap, really. But the teacup trades, hopefully you've been working this out already, but usually it's a 30 pip stop loss. The pro signals are usually a 50 pip stop loss. But I want to talk to you about the difference between pending orders and market execution. Right, so pro trades are usually, well, everyone I've seen so far, have been market execution. This means you're entering the market immediately. What you need to do is you need to check your price on MetaTrader 4. So you do your pip calculation from there. So you'll see whatever the price is, and then you work out what the price is now and what the stop loss is. The reason why this is important, the pro trades, they come out and move. Sometimes I've looked and they're 15, 20, 10 pips in profit already. So if I'm using the stop loss that they give, if it's already in profit, the stop loss is higher. So it's 60 pips, 10 pips in profit already. You need to adjust your lot size for that or bring your stop loss. So hopefully that makes sense. I can go through that with you individually if you need clarification on that. Pending orders, again, hopefully you know what all these are, but a sell limit, a sell stop, buy limit, you're entering the trade at the exact price. So your stop loss will always be the difference in prices as you enter them on MT4. They'll never ever change. So you can always work out your lot size. You can then place that, leave it, and you know it's right. So hopefully you found that helpful. It's a bit of a whistle-stop tour, but I hope I've delivered the message that account management, risk management is fundamental to you being a successful trader. It doesn't matter how many you lose small and hopefully win bigger. That way you stay in control. Let me know what you think of the video. We can always, like I said, arrange a like a live Q&A session, and you can do some live stuff, like whatever you need to help you with risk management or anything you need. Just drop a message in the group, message me privately, and we'll get something. But that's all from me for now. I hope you found that helpful, like I say, and have a good day.